So I put out a news item that interest rates were actually not raised by Australia, and that led to several comments on Twitter. So I thought I'll do this short video. One of the reactions was that what if the US continues to raise rates? Now that's already off the table. I mean, so we should not talk about something that's not likely to happen. Inflation is already going to roll over. It's already flattening out. It's going slow. That is why the Fed is moving slow. So this is already priced in, which is why the bond market has already started to fall. That is, bond yields have started to fall. Bond prices have started to go up. The market has started to price in a lower interest rate environment. Now the question is whether other central banks wait for the Fed to do that first, or whether they can take a cue that, okay, this is what is likely and let us move there first. Now that is where each of the independent central banks are going to be taking their own action. So that is what is happening right now. But to imagine a situation, let's put it this way: can the US or would the US really want to keep raising interest rates beyond a point? So there is a cutoff point. They may say they don't mind going to 6 and 7%, but the amount of damage that would do not just to their economy, but the bigger risk is not the economy. The bigger risk is the sovereign debt issue, because they are net borrowers even as they go into this debt ceiling, which as always they will raise again in the last moment. So that's not the real issue. The real issue is they've got trillions of deficit, when they didn't really bother about the debt ceiling. When you had a 200 billion deficit, now that you have a $2 trillion deficit, are you really going to be tinkering with that? Because it really hurts your treasury market, your ability to borrow and so on. So that's something you don't want to get into and touch. What that really does then, if you're going to keep expanding money at some level in some way or the other, is that eventually it means a weaker dollar. Some people are calling that de-dollarization, but that's not de-dollarization. A weaker dollar is essentially an environment where the US is creating more dollars than others. Now, does it trigger de-dollarization, which is a long-term trend? I think the big step in that direction was when the US actually took punitive actions on Russia. That is the kind of macro step that pushes people towards de-dollarization as a macro theme, that suddenly people get scared that, if I own dollars and if I don't listen to what the United States is really telling me to do, then they may just take away my entire dollars held in their banking system. Now that can be a fear, but otherwise it's a slow process. It's not something that happens overnight, but it will happen slowly. And hopefully in a way that we won't realize, and it just transitions. Like, for example, do you really remember when we transitioned from a pound sterling environment where that had become the global currency to a dollar currency? It happened somewhere in the late 18th century, but you didn't really realize it as a date in history where this is the date when it happened. And so the same is going to be the case with the dollar. Now, there are a couple of other questions that someone has just thrown up and that triggered me to have this discussion. Like, we have put out a YouTube video, which is something I recorded yesterday. So it actually doesn't, or day before, so it doesn't take into account, and that's from my podcast basically. So it doesn't take into account the new measures like the oil, OPEC measures to really expand, rather to cut oil production. And what would be the implication of that, say, for India? Now, oil prices have moved up. They are going to bottom out at 60, something I was already anticipating. Did we really need an OPEC to come in and drive it up faster? Maybe not. It was anyway bottoming out structurally, because $60-65 range is where the previous fourth wave was. So Elliott wave wise, that's where we typically expect a bottom, and that sort of happened. Now what the OPEC action does, it just triggers and sort of creates the case that yes, this is a level below which we are not comfortable when it comes to oil prices. So that's essentially what they're trying to say. It doesn't mean they immediately run away to $200. If that has to happen, there would be completely different reasons, probably more geopolitical. There is some case building up, as I was hearing in some interviews today, for a geopolitical risk, which is that the Ukraine-Russia conflict could actually, reach its final stage sometime in May, June. I don't know if it really works out that way, but that's what I was listening to, because a lot of troops have been getting trained to help Ukraine for the war, and similarly, even Russia may then increase its troops as we go into summer. And so somewhere at that point of time, we may see the final blow off of that conflict, and we'll see how that ends. And that could probably be one of the geopolitical risks to oil price and commodity price action. But purely technically, you have an environment where the dollar has peaked and is falling, and that usually means higher commodity prices. And that's what we are probably seeing with oil, even if we don't get the geopolitical angle in. What I would hope for from an inflation standpoint is not that you don't get rising oil prices, but that they rise more slowly. I think that is the main point when it comes to thinking about inflation, because it's not whether you're at 90, but that, yeah, you were at 90 1 year ago and you're at 90 today, therefore Y on Y it's 0%, and therefore it's not inflationary. That's what is going to happen. It's not about bringing prices down. We are simply going to end up at a new price level, at a higher price level, where we would then say, fine, this is now acceptable, and this is sort of where we've managed to control the rate of inflation, which is the point that is of focus, not the price level itself. And that is where people don't understand the fact that stock markets, which are essentially a reflection of price, because profitability is a function of product into price and margins. If you really raise the price level of everything and put it at a new level, then you also raise the price level of the market, because price is one of the factors inside the stock's revenue and earnings. So that's why markets do not fall too much in an inflationary backdrop. Even though you may try to raise rates, if the real interest rates are not positive, they're still negative. To that extent, you're actually supporting markets. That's something to really keep in mind and understand, because the trade is not equal to the narrative when it comes to the inflationary environment. We simply can't say interest rates are going up, therefore markets should fall, but real interest rates are 7% negative. It's not going to work, at least not beyond a point. You will get a knee-jerk reaction in the near term, but eventually if you persist with that kind of a data point over a 6-12 month period, markets will rebound and start pricing in the higher price levels, and move on from there. That's sort of what happened in the early 1980s. So what would be the implications for India? Well, we will be buying oil at a slightly higher price, but we've been buying it at lower prices from Russia anyway. So therefore, the immediate implications may not be that significant, but it does affect our current account deficit. But then again, we can fund that through various flows, and flows are the real issue that India is facing, not more than the oil price and gold price. It's like we actually have had negative FPI flows, right? Foreign portfolio investors. It's not really bringing in money, which is one of the supporting points to our current account deficit. Even though our CADs come down because of better exports, you would really like the FPI balance to improve, so that we don't face an immediate problem on the balance of payments. So that's, I think, the real missing link more than the oil price.